we kick off a new trading week, geopolitics, politics, as well as fundamentals will be in the spotlight. So joining me now is Keith Bliss of Cuttone and Company. Keith, happy Monday to you.
Same to you, Remy.
Well, it's another session, and that means another opportunity for the equity averages to hit new record highs, and indeed we are at those record highs today. But given that we have so much going on politically, geopolitically, as well as earnings coming out, what's your key focus this week?
Well, it's really going to be about earnings. You're right. We've been dealing with a lot of things coming at us every day, every week, every month for the last 5 or 6 years about it. But when it comes time, once a quarter, we do focus on the earnings, and clearly that's going to be the case now. When you take a look at where the S&P 500 is, the 12-month forward PE on the S&P 500 is at an all-time high. It's at an 18 multiple. So this quarter and the subsequent quarters coming in behind it will have to support such valuations if investors want to stay in there. So we've got some big earnings coming out this week. Not only do we have Netflix coming out after the market, but we've got companies like Morgan Stanley and Goldman Sachs and IBM tomorrow, and then later on we've got eBay and PayPal and American Express, and then the following week we start to really get into some big consumer names and big industrial names like we're going to have this week. So it's all about earnings. Donald Trump can tweet whatever he wants. Kim Jong-un can say whatever he wants to say. For the market, it's going to be about earnings this week.
Well, I'm glad that you made that point clear, because we have so much happening politically here in D.C. as well as overseas, with elections happening as well. But in addition to that, today we're seeing oil prices extend gains, both WTI, Brent higher, and that is on the heels of tensions in the Middle East. So what do you make of that?
Well, that's simply the only reason why it's moving higher. We don't have either Brent or WTI is overbought yet, although the energy complex and the commodity itself are the most overbought in a very neutral market for us at this point in time. But if those tensions ease, which we're all hoping they will, I think you'll see the price pressure on the commodity come in quite a bit, and we'll get back to a normal level. I still hold to my thesis that I've had for a couple of years now, that once WTI came off of those $100 a barrel, $110 a barrel highs and really came in substantially, all the way down to $27 a barrel, I think that it will remain settled in a nice range between $45 and $55. So if he gets up to $55, $60, I think I'd be shorting the commodity at that point in time and then just play that trading range right now.
And last but not least, before we wrap it up, I do want to talk about central banks. Over the weekend, Janet Yellen spoke, and at the end of this week, she will speak again. Now, during the week, we will be getting other central bank speeches as well. So what do you expect to see in terms of global monetary policy?
Well, I think it's going to remain, very accommodating, despite what Janet Yellen may be saying about inflation is absolutely going to creep in. I mean, when you go back and pull the transcripts on what she said, she's been saying this ever since she's been Fed chairperson. And Mario Draghi's been saying the same things. We hear similar types of sentiments out of the Bank of Japan. Listen, for me, and I think the market, you can see it in the market, the proof is always in the pudding. The 10-year yield has a tough time breaking above 3%. It comes in. The equity market continues to run forward. If it was truly worried about a spike in interest rates and very restrictive monetary policy, you would see that start to sell off. Even if they were right on the mark about inflation finally creeping into the economy, remember, we are in a secular decline on interest rates for the last 20 years, so there's nothing to suggest that we're going to go back to the interest rate days of the late 80s, early 90s, when you had to buy a mortgage at 12%. So I wouldn't worry much about these things going forward. Monetary policy will remain accommodating.
Indeed. Well, thank you so much for joining me, Keith, and thank you so much for your insight and perspective as always.
It's my pleasure.